So welcome to our summary of the FOMC meeting today, and I'll be brief. I'll try and be brief and concise and go over what happened, the reasons behind it, and some of the interesting stuff which I think happened in the press conference. Now, the decision itself, as we all know, they decided not to cut. There was a 96% chance from the futures market that would be the case. That's what markets were very much expecting. So there was no interest really in terms of the actual action. There was a lot of interest in what Powell would have to say about Fed independence, because clearly there's been a lot of pressure from the president to cut interest rates. And that has been something which has certainly rattled markets. So there's been a huge market reaction when Trump has threatened to fire Powell. He's often had to step back from it, and that caused markets to recover. So I think he can see that markets will punish that kind of EM type behavior if he tries to take control of monetary policy and tries to erode central bank independence. So there was certainly commentary about that, which I'll go on to. But just stepping back for a moment, I think it's fair to say that the US economy is in a pretty strong position. We've just had the GDP numbers that came out recently, and it was pretty strong, although we'll talk about that as well. We'll dig into one of Powell's preferred measures, and which strips out some of the distortions we've been seeing due to trade recently, and that shows a picture which isn't quite so strong. But if I had to summarize today's meeting, it would be a tension in the mandate. So the two sides of the Fed mandate is full employment and price stability. They try to get as many people in work as possible, and at the same time they try not to have too much inflation. They aim for that 2% target. And these two mandates are pulling in opposite directions in terms of their monetary policy. What we're seeing is a slight weakening of the economy. We'll dig into that. At the same time, we're seeing slightly upward pressures on inflation. And that means that their policy is pulling in two different directions. Higher inflation suggests that they should keep interest rates where they are. They should keep it restrictive. And if it is the case that the economy is weakening, that's suggesting they should cut rates. And at the same time, they've got huge pressure from this administration to cut rates. It's also at the back of people's minds that in May of next year, Powell's going to end his Fed chairmanship. And the question is, will Trump put someone into the Fed chair position who's simply going to be a yes man, who is just going to pick up the phone and do whatever Trump wants? And if that happens, as we'll see again, Powell had some fairly strong remarks about central bank independence and why it's a good idea. So let's dig into those details now. I think what was interesting is the expectations. So let's quickly look at where markets expected things would go and where they actually went. And I'll share with you. So here is the backed out market expectations. So each of these rows here is one FOMC meeting date. So we've just had the 30th of July, and then the next one's in September. What we're seeing here is what the rate is that the market's expecting. So what's the probability of being in this rate band on this date? So you can see the probability today was almost 97% that they wouldn't cut. So we're currently at 4.25 to 4.5 is the range for the Fed funds rate. In September, markets are expecting it's very likely, there's a almost 60% probability that we're going to get the first rate cut. And the reason for that, of course, is that it does look like inflation's on the way down. It did tick up a bit recently, so we're going to have to see what happens to the data. But the economy's also weakened a bit, so that would tend to push rates down. So September is what the markets are expecting. And then another cut in December. So 2 cuts for the remainder of the year. And then next year, so far, they're pricing in just 2 cuts. Now, remember what Trump has asked for is a 2 percentage point cut from where we are right now. So instead of 425 to 450 as the range, we'd be talking about 225 to 250. And what the market's pricing in here is nothing more than a bit of noise. There's very low probability that we're going to get such a radical cut. So remember that May of next year is when Trump's new Fed chair is going to take over. But clearly markets don't think that Fed chair is going to cut to where Trump wants rates to be cut. But it'll be interesting to see how these probabilities evolve, because that'll be the new Fed chair's remit. Let's also have a look at those GDP numbers, because second quarter GDP is just out and it was 3%, way better than expected. It was better than expectations. And here's Trump's Truth Social post, where he says, too late, that's what he calls Powell, not very politely, must now lower the rate. No inflation, he says. Of course there is inflation. Let people buy and refinance their homes. So he's saying that it's about mortgage rates, and he's a populist, so he'll say what people want to hear, which is that, oh look, you can have cheap mortgages. Whereas in fact, I'd say it's more about debt servicing cost. The government's passed this big beautiful bill, and that's going to push up government spending, and the tax cuts that's imposed. So they are cutting some spending, but the tax cuts are going to reduce the government's revenue, and the tax cuts are going to mean that the government's got less revenue. So overall, the fiscal position is that the fiscal deficit remains large. The government's carrying on spending more than it earns in taxes, and the tax cuts certainly haven't helped with that. And they haven't cut spending enough to offset the tax cuts. So that's how you fix the problem. You spend less and you tax more. But that's not what we're seeing. We didn't see it from the previous government. We're not seeing it from this government. So really expecting the Fed to cover up for the inability, the unwillingness to balance the fiscal position is, I think, unfair. It's not really their remit. The government could change the Fed's remit, but as it stands, that's not their job. It's not their job to reduce the cost of servicing US debt. But certainly the US GDP numbers are okay, not mind-blowing, but okay. Now, there are distortions in that GDP, and that was a point that Powell kept coming back to. Because of companies bringing forward their imports before tariffs kicked in, that's distorted the GDP numbers. Now, if you strip out those imports, this measure, which is real final sales to private domestic purchasers, this gives you an insight into the underlying demand for stuff from US consumers, which is one of the real engines of the US economy. So when this number goes down, that suggests that the underlying US economy is weakening. There's less demand for consumers to buy stuff. And that's exactly what we're seeing. So these are the quarterly numbers. And we have seen that go down fairly sharply. It's still not in recession territory, but it's not great. So we kept on coming back to this measure and this number. Lots of the questions from the press were about this number. And if we look at inflation, you can see that it has come down hugely since its peak. Now it's down to 2.9 for core, 2.7 for headline, and that's CPI. And unemployment remains low. That's good for the economy. That's a fairly good measure of whether the economy is in good shape. And the actual inflation measure which the Fed looks at is personal consumption expenditures inflation. And the core number there has ticked up a tiny bit, but not a lot. And we're not too far from the Fed's target, but you can see that it doesn't really seem as if it's coming back down to 2. It's annoyingly staying at 2.7. And Powell actually talked about one of the components of that currently is that previously what we saw was that services inflation was keeping inflation high and sticky. Well, that's abated now. And it's now goods inflation which is pushing up inflation. And it's also partly because of these tariffs, because those have been passed on in part to consumers. some of the increased costs have been absorbed by the companies who are doing the importing, but it is of course a tax on US companies and US citizens. So let me just go back to some of the press conference questions which I thought were really interesting. So I'll just highlight a handful of these questions and then we'll throw it over to you to ask questions about investing and the economy. So I think the first one was about dissent, right? So whereas with the Monetary Policy Committee in the UK, the Bank of England's rate setting committee, there's often dissent. So when you see those votes from our committee in the UK, you often see people disagreeing with the central case. For the Fed, it's extremely unusual to see that. And what we saw is that for the first time in more than 30 years, two of the FOMC members, so this was Michelle Bowman and Christopher Waller, wanted a rate cut straight away this month. And what was interesting was that Powell was just discussing how they actually have the meeting. So yesterday they had a meeting where they had a round table on the economy. They talked about what's going on, inflation, unemployment, growth, all of that good stuff. And then today was the meeting about policy. What are we going to do with rates? What are we going to do with the balance sheet? And what he said about the dissents was that what you want from everybody, and also from a dissenter, is a clear explanation of what your thinking is and what the arguments you're making. And that's what we had today. And he said this was one of the best meetings he remembers. But clearly it is a subjective decision. Two people who are both reasonable can interpret the data in different ways. And if they think the weakening of the economy is greater or more than justifies the risk of higher inflation, then sure, they'll ask for a rate cut. And it is a finely balanced decision as it stands. Another interesting question was about tariffs affecting inflation, because the expectation by many people was that by now we would have started to see a ticking up in inflation due to tariffs. And certainly Powell said that there is starting to be that effect, but it takes a while. And really the big question for the Fed is, will this one-time step up in prices become anchored? Will people start to expect inflation to be higher, and will it be a more long-lasting phenomenon as a result? And so he said, the evidence seems to be mostly that exporters are lowering their price, and companies who are upstream, institutions that are upstream from the consumer, are paying most of those increases in prices for now. But what he does expect is that it's going to show up more in consumer prices later on in the year. So this is just the beginning, the foothills, if you like, of the inflationary effect of tariffs, potentially. That's what the Fed expects. But he does say that companies feel they have every intention of putting this through to the consumer eventually. So they can weather it for a while, but at a certain point, consumers are going to have to pay more. He said, I think we've learned that the process will probably be slower than what we expected at the beginning, but we never expected it to be fast. And we think we have a long way to go to really understand exactly how we'll be. So that's how we're thinking of it right now. So they're just waiting and seeing for now. Yeah. So price stability, that was another question. Yeah, so there was a question about fiscal policy. Do you have concerns about the cost to the government of keeping rates elevated for longer terms, and that's going to increase interest rate charges? So really the question was, if you keep rates high, it's costing the US government and the US people a lot in interest. So why are you keeping that? Why are you not concerned about that? And Powell's answer was completely true, which is that it's not their mandate to consider interest costs for the US government. Their mandate is about maximum employment and price stability, and it's not something we do to consider the cost of the government of our rate changes. Now, it could be that government decides to change their mandate, but certainly for now, that's not true. And he said, we don't consider the fiscal needs of the federal government. No advanced economy central bank does that. And it wouldn't be good for us if we did do that. It would be good neither for our credibility, that's the Fed, nor for the credibility of US fiscal policy. Now, if you're spending more than you're earning in taxes, the way you fix that is to spend less or earn more by taxing more. It's not to force your central bank to cut interest rate to cover up your failure of fiscal policy. So that's a really important point, and there's a reason why other central banks around the world don't have that as part of their mandate. And if the US changed it, I think it would be taken very badly by markets, certainly by bond markets. So more questions, of course, about Trump and what he's been saying, the quite unpleasant comments he's been making about the Fed chair, about Powell. He has personally pressured you, the journalist said. Are you concerned the way that conduct might impact the Fed's independence going forward? And Powell said, I think having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should automatically defend. So he thinks independence has been good for the US consumer, for the US citizen, for the US economy. What it gives you, he said, is the ability to make these very challenging decisions that are focused on data and the evolving outlook, i.e. the economy, and the balance of risks and all the things we talk about, and not political factors. So it keeps politics out of the rate decision. And he says that governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there'd be a great temptation, of course, to use interest rates to affect elections, for example. And of course, that's something we don't want to do. So very clear case for why central banks are independent and why he thinks that should continue for the US as well. There was talk about the quality of the data that the Fed's been getting, because the Bureau for Labour Statistics, there's been talk about making an 8% reduction in headcount to cut costs as part of the much wider cut in costs for the US government and the wider layoffs for the US government to save money. And the problem is, of course, that if you want to collect data on prices for a $20 trillion economy, you've got to have people who go out there and collect data. Now, the alternative is to impute prices. So instead of actually measuring individual prices at stores all across the US, you kind of guesstimate, use model-based, probably regression-based estimates based on a subset of the prices. So I don't know, if apples go up, maybe oranges go up as well, and that way you only have to measure one of the prices. But of course, it's not as good as measuring both of the two different fruit prices. He said he didn't want to comment on the administration's proposal for the cut, but he says it's really important that good data helps not just the Fed, it helps the government, it also helps the private sector. And he said, we've been collecting this data, the US government, for 100 years. We've been getting better and better and better. It's very hard to capture in real time the output of a $20+ trillion economy, and the US has been a leader in that for 100 years. And we really need to continue that, in my view. So again, the US is a very rich economy. It can afford to measure inflation accurately. It feeds into the private sector, it feeds into government policy. So why would you choose not to measure that accurately? Is there a reason for that? I wonder. And yeah, so more questions about that government data. So I think that kind of sums up the meeting, right? Lots of questions about Trump, lots of questions about pressure on the Fed, about Fed independence. Some are questions about the economy, of course, and unemployment and policy. He really didn't give any kind of hint about what's going to happen in September. Markets, as we saw, expect that there's going to be a cut in September, but he didn't give any clues as to that. But usually the markets have a fairly good guess about the next meeting. So as we watch the probabilities evolve before the next meeting, my money would be on a cut for the next one, but we'll see. It really depends on the data, as they always say. Right, so let's pause. Let's pause there. And I'll summon my cockapoo for treats. And he'll get a burger, because these are his new fancy treats. You can ask questions now. Please do like and subscribe if you do like and subscribe our stuff. And if you do like our stuff, please do subscribe. And hopefully Teddy will hear some paws on the stairs in a moment. So do think about your questions. If you do a super chat, we'll push you to the front of the queue. And if you're one of our supporters on YouTube also, we'll push you to the front of the queue for the questions. Somebody's saying, where's Teddy? He's on his way. Here he comes. Yes. This is his burger. It smells really good. It's got spinach in it. Would you believe? Oh, you good boy. You're going to get built on later. Now, I'm on a diet, so he's been getting less meat recently. Normally he gets a bit of my meat when I have dinner, but it's been pretty thin gruel recently for the last few days. So the poor thing, he's relied on these treats. I'll tell you what, you're going to stand for one. You don't rest on my leg. You have to stand up, right? You have to work for it, Ted. Oh, beautiful. Beautiful standing. One more. Oh, up. Oh, good boy. Are you going to go and get one from Laura? You can get a treat from Laura downstairs. He's listening. Yeah, go on. We'll get downstairs now. Go on. She's downstairs. She's got built on. The lid's on. Go on. You go to Laura. Good boy. Yep, there it is. The rattle of the biltong. The whistle. Yes, he's off. Brilliant. Right. So yeah, any super chats will push you to the front of the queue. I see there's a super chat already. No question, but Billy Kotsos says, big fan. Thanks, Ramin. So I assume that. Thank you. So I thank you for that, Billy. That's great. Didn't Teddy used to be behind you on the wall? Is Teddy okay? Clearly, he's fine. Proof of life. You just saw it. Okay. Laura said, sitting at my feet, he'll shoot up the stairs. How do you feel about the recent Acqui results? Let's have a look at Acqui. Ooh, a bit of a wobble. A bit of a wobble. So let's have a look at Acqui. So this is the All Country World Index. This is a global index. This trades on the London Stock Exchange. Oh, that's the wrong one. But it tracks the same index. Let me just get the other one, which is State Street, which is the one I own. Not a recommendation, by the way. Let me pull it up on ShareScope. That's probably the best way. There we go. Right, so this is Acqui, All Country World Index. It's denominated in sterling, so if the US dollar strengthens versus the pound, that pushes up the value of this thing. The weak dollar's been dragging it down recently, but I suspect recently, over the last couple of days, the dollar strengthened, and that's been good for Acqui. And certainly it doesn't seem to have taken much of a hit recently. So no huge change, I wouldn't say. So that's as of today's close. It was a bit of a wobble, not huge. Let's have a look at sterling versus the dollar, because that responds to macroeconomics pretty quickly. And you can see that sterling has started to weaken versus the dollar since pretty much the beginning of July. So it is nice to see the big weakening from my point of view, from my portfolio's point of view, because that's been a huge headwind for UK investors investing in US stocks. So that reversal is quite welcome as far as I'm concerned. Now, if we go all the way back to 2022, you can see it has been a strengthening trend for sterling versus the dollar, but that weakening has been very rapid recently. I think part of that is due to the trade deal between the US and Europe. So Europe has agreed to buy lots of energy products, and it pretty much caved to Trump's insistence of tariffs. Now they've got, I think it's roughly 15% on their exports to the US. All of the arguments about the US being a huge, powerful trading bloc with huge counter tariffs that it could impose, being scary, all of that was pretty much bluster, turned out to be a paper tiger, and it just rolled over and succumbed to Trump's policies. So I think the US has been partly in the blowback from that, but the dollar's certainly strengthened a lot on that recent news. But there hasn't been a big pullback in ACWI at all, as far as I can see. Maybe you want to do a follow-up question about that. But I don't see a huge negative effect there. How do you see the developments in the trade war and upcoming deadlines will affect markets going forwards? Yeah, I think it's pretty clear that obviously we are starting to see the tariff incomes start to kick in. There's been a lot of song and dance about it, but as a proportion of the total income for the US government, remember that is tiny, and you can't substitute taxes for tariff revenue. Tariff revenue will just never be big enough, and if it was big enough, it would have such a chilling effect on the US economy that it just wouldn't be realistic. So sure, it's generating revenue, of course it is, that's the point of a tax, which is what it is on US corporations and US citizens, but yeah, I think it's not going to be good for the US economy, that's pretty clear. We're going to see an effect on US exports, probably as well. I suspect the longer term impact is going to be on a lot of countries are now going to be thinking about circumventing the US as a trade partner if they can. If you're Canada, very tricky. If you're Mexico, again, very tricky, because a lot of trade, physical trade in goods, is geographically based. That's still the case today. We still need stuff, and stuff costs to transport. So you will trade most with your neighbours, usually. Services, of course, is very different because that's electronic. You can beam information across the world almost immediately. But goods cost money to move from A to B. So I think that's the problem for the US, which is that if countries can avoid them or focus on trade with other counterparties, they now will. And suddenly China, which was seen as almost a pariah, I'd say, before these recent policy changes, is now seen as the stable partner. So if you're the UK, where basically we've thrown up barriers between ourselves and our nearest trading partner, the EU, you're looking desperately for other trade partners. Well, sure, we want the US, but we'd also want China. So the question is, is it either or? Do we circumvent the US in the future if it's unreliable as it is now and it imposes these tariffs? And do we preferentially export to countries which don't, at the drop of a hat, increase tariffs and which abide by international law, which people have hashed out over many decades? So I think it's going to be bad for the US economy longer term. Shorter term, there may be some victories, but certainly the one with the EU is a big one, because in terms of the US imports, the EU is the biggest trading partner. So that's been good. But for China, I think China's got the strength to say no, actually, we'll impose counter tariffs. And they also have control of things like rare earth metals, which the US desperately needs. So I think they're in a much stronger position. But we'll just have to see what happens to this trade war and the ultimatums that we're seeing. But certainly nothing like what we thought it would be initially when we had that blackboard with all the crazy numbers on it. But 15% for Europe, pretty high, and the euro sold off hugely as a result of that. In fact, why don't we have a quick look at that, the huge euro sell-off. The biggest currency pair, remember, is euro-dollar. So it's euros versus the dollar. That's the most traded currency pair of all, right? So let's have a quick look at that. So here's the euro-dollar rate. Now, you can see that if we just do it year to date, the general trend has been the euro strengthening versus the dollar. And then recently, after this trade agreement, we've just seen the euro tank, right? It's a huge fall over a fairly short space of time. It hasn't eroded what's happened year to date, but I wouldn't be surprised if we lose a lot of those euro gains versus the dollar. So no question, this has been a huge blow to Europe and also the credibility of Europe and its strength, if you like, you know, big questioning of its strength as a trading bloc, which is the whole raison d'etre, of course, of Europe and the Eurozone. So, yeah, not good news, I don't think, the tariffs. And but, you know, how long have we got left of this presidency? 3.5 years. So I think people are always thinking, you know, what's going to come next? You know, is it going to continue as it is after Trump leaves office, or are we going to see a thawing of tariffs at that point? And my expectation would actually be that there'll be a lot of step back from the previous tariffs, which incidentally I think would be very good for the US economy. Oh, okay. Somebody says, oh, nice to see Lynn and Andy are here. They always join us. They say, hi, Ramin, Laura and Teddy. Nice to see you. And we've combined our chat. Both of us are here. Lynn and Andy now. Very good. Always nice to see friends there. Javi says, the Fed is not independent. Very naive comment, in my opinion. Okay. I'd argue that the Fed is independent, actually. Spherical Hang says, if the... Oh, we've got a super chat, actually. Let's go for the super chat. Which fund would you say is safer, VHYG or VWRP? Well, I'm not sure what you mean by safe there. So let's have a look at VHYG, which is the high dividend yield. And it's an all-world high dividend yield fund. And we're going to add VWRP. And I'm going to do this on the fly, so please forgive me as I just scrabble desperately to add VWRP, which might be on this list already. Is that the one? I think it is. Vanguard FTSE All World UCITS ETF. Yeah, I think that's the one. VWRP. Well, let's just add VWRP. It's just as easy. Add, create VWRP. I think that's the one we just saw actually, but still, let's be doubly certain. Okay, no, it wasn't. So, the question is which of these is safer? So VHYG, let me just remove the other one just so it's clearer. Delete that one. Right, so these are the two. One of them is very much focused on dividends, right? So it's going to choose companies which pay high dividends preferentially. It's all world, so it's giving you diversified global equity exposure, but it'll have a tilt towards value because remember, high dividend is another version of value. So what we should also do is plot total return if we can. And I think VHYG is an accumulation fund. Yes, it is. So back to the chart. And I know VWRP is an accumulation fund. So let's plot the two versus each other. Now, what I'm going to plot is, rather than the price, I'm going to look at reinvested total return. So that means that if it wasn't an accumulation fund, it would have reinvested the dividends. I think these are both accumulation, so that'll be the same. But what you can see is the volatility of both of them is pretty high. If we look at the crash that we had, well, not crash, let's call it the tariff pullback, you can see that the one which fell the most was the FTSE, yeah, it was the FTSE All World one. So that was the VWRP fund. Now, usually if you have a tilt towards income, it'll also be a tilt towards boring sectors like utilities, which pay high dividends. So you'd expect that to be more defensive. In an era when interest rates are low, that would also favour high dividend stocks. So if we are seeing a cutting trend, people would tend to buy stocks which are high dividend payers, because you don't get such good rates from risk-free investments. So yeah, if you want income, VHYG is pretty attractive. If you think that equity markets are going to soar from this point onwards, you'd go for the VWRP. If we think we're going to have fairly weakish US economy and global economy weakened by tariffs, then you'd probably go for VHYG and just clip coupon and clip the dividends, and that would probably be a better choice. So in terms of safety, yeah, VHYG is less crashy. It's also less exciting. So if you want capital growth, you'd go for VWRP. Personally, I think in this kind of macro environment, I'd probably tend towards VHYG at the moment, if I had to choose one or the other. Now, personally, what I've bought myself is like VWRP. So that's my core holding. I'm sticking with it. But, if I was being cautious, I'd go for VHYG, to answer your question. So I hope that does answer your question. Are high dividend funds safer? Well, if you're going to be investing for 20, 30 years, I'd say that you'd probably underperform with VHYG. You'd probably get a better total return with VWRP, because if you're going for the high dividend stocks, you're foregoing capital growth. And I'd say that something which goes for capital growth will probably do better, which has more of a focus on capital growth. Simply because defensive sectors underperform usually, I'd say, growth sectors. That's certainly been the pattern we've seen over the last 20 years. Growth has been the much more dynamic, high return strategy, whereas value and high dividends have been languishing for quite a period of time now. Anyway, so back to your questions. We will keep it fairly short actually, because it is getting a bit late here. And a couple more questions. Better that we just get spending under control, not pressure the Fed to lower rates. What? WTF is wrong with society and our brains. Short-term solutions, long-term pain. Yeah, I agree with you, Kay Breezy. I think it's not just... I think the government just has to get the fiscal situation in the US under control. Because if the debt market goes wrong, and often everything's fine until it isn't, you start to get people repudiating you start to get people not wanting to buy US debt, not wanting to buy US debt. That pushes up yields, and the debt servicing gets worse. So it's a kind of spiral effect if the country loses fiscal credibility. And that's what we're seeing right now. You don't have to believe Ray Dalio to see that there's a problem. There's very clearly a problem if you look at the debt to GDP dynamics in the US. So living beyond your means, if you're the US, is okay for a while, but not forever, even for an economy like the US. This looks interesting. Can you do a summary of how spread works when buying? How do you calculate it? How do you pay it, both when buying and selling? When should it influence investment choice when picking funds? Well, the idea behind spread, the idea is that this is how market makers make their money. So let's say you want to buy an exchange traded fund. The buy price will be high, the sell price will be low for you, because the market maker has the opposite side of that. They're buying low and selling high. That's how they make their money. You multiply the number of trades by the bid offer spread, and that's roughly how much money they make in a day. So the bigger the bid offer spread, the more money they make. Now, for a name which has lots of volume, and generally high market cap stocks and funds have more volume, more trading volume, the trader can make, the market maker can make lots of money even with the tight spread, because they're shoving more trades through every day. So the volume multiplied by a smaller spread can still be substantial in terms of revenue. So if you plot bid offer spread, it correlates very strongly, inverse correlates with the market cap. So big companies, small bid offer spread. Same for funds. If you have a small fund, you get a big bid offer spread. So look, if it's on the London Stock Exchange, you can look up the bid offer spreads. But that's the pattern you'll see. Big fund, big stock, big market cap, you don't have to worry about the spread. But look, you shouldn't be worried about the spread anyway, because you won't be trading a lot, I presume, unless it's really extreme. I mean, for some of the small cap stocks I buy, the spread is, upwards of 2 percentage points, right? 2% difference between buy and spread. For a big company like Exxon, the bid offer spread will be tiny, absolutely tiny. But you shouldn't be trading a lot anyway, because generally it's bad behavior, and why would you be trading a lot? It's not usually in your interest to do that. So bid offer spread, I'd say that it's not something that should concern you a lot, unless it's extremely big for tiny companies. So I'll just check before we go that we haven't got any more, because there's usually a last minute question which I miss, but there wasn't this time. So thank you all for joining us. Please do like and subscribe, and join us for our next one of these meetings. And of course we cover the Bank of England's Monetary Policy Committee as well, so we'll be covering the next one of those. So thank you for joining us, and please do think about joining our community, PensionCraft.com/membership, if you want to learn more about investing. And you get access to lots of goodies, lots of members explainers, and you also get to chat to our community live using our chat application. So thank you for joining us, and see you at the next live stream.